Financial statements. Financial statements are the reports that illustrate the financial activities and position of the business at a particular point in time. These statements depict the business's performance and financial health. The complex data must be presented clearly to all the stakeholders, such as investors, creditors, and management, so that they may evaluate a business's performance, stability, and growth potential, and assess whether the business is headed in the right direction. Purpose and importance of financial statements. For managers, to make strategic decisions and plan for the future for improvement in profitability and efficiency of the business. For investors, to assess a company's financial health, stability, and growth potential before making suitable investment decisions. For creditors, to evaluate a company's creditworthiness and its ability to repay loans before extending financing. For regulators, to ensure compliance with legal and accounting standards, such as International Financial Reporting Standards, IFRS. Primary financial statements prepared on quarterly or annual basis. 1. Balance sheet. The balance sheet provides a picture of a company's financial position at a single point in time, such as at the end of a quarter. It is based on the fundamental accounting equation: assets equals liabilities plus owner's equity. 2. Income statement. This is also known as the profit and loss (P&L) statement. This report depicts a company's financial performance over a specific period, such as a quarter or a year. It shows how revenue is converted into net income by subtracting expenses and costs. 3. Cash flow statement. The cash flow statement reports the actual cash generated and used by a company over a period. It details cash inflows and outflows by categorizing them into 3 areas: 1. Operating activities; 2. Investing activities; 3. Financing activities. 4. Statement of shareholders' equity. This statement shows the changes in the owner's stake in the company over a reporting period. It shows how events like net income, dividends, and the issuance or buyback of stock affect total equity. Balance sheet. The balance sheet provides a snapshot of a company's financial position at a single point in time, such as at the end of a quarter. It is based on the fundamental accounting equation: assets equals liabilities plus owner's equity. Assets: what the company owns, including cash, inventory, property, and equipment. Current assets: expected to be converted into cash within 1 year, e.g., cash, accounts receivable. Non-current assets: long-term assets that are not easily converted to cash, e.g., property, plant, and equipment. Liabilities: the company's financial obligations and debts owed to others. Current liabilities: due within 1 year, e.g., accounts payable, short-term loans. Non-current liabilities: long-term obligations, e.g., long-term debt, bonds payable. Owner's equity: the residual interest in the company's assets after deducting all liabilities. It represents the owner's or shareholder's investment. Income and expenditure or profit and loss statement. This report details a company's financial performance over a specific period, such as a quarter or a year. It shows how revenue is converted into net income by subtracting expenses and costs. Revenue: the total income from sales of products or services. Cost of goods sold. COGS: the direct costs attributable to producing the goods or services sold. Gross profit: revenue minus COGS. Operating expenses: costs not directly related to production, such as salaries, rent, and marketing. Net income: the bottom line profit after all expenses and taxes have been paid. Cash flow statement. The cash flow statement reports the actual cash generated and used by a company over a period. It details cash inflows and outflows by categorizing them into 3 areas. Operating activities: cash flows from a company's core business operations. Investing activities: cash flows related to the purchase or sale of long-term assets and investments. Financing activities: cash flows from debt and equity financing, such as issuing stock, paying dividends, and repaying loans. The primary purpose of the CFS is to show stakeholders where a company's money is coming from and how management is spending it. Statement of shareholders' equity. This statement details the changes in the owner's stake in the company over a reporting period. It shows how events like net income, dividends, and the issuance or buyback of stock affect total equity. Statement of shareholders' equity is used to assess how much money is left for shareholders after the company pays all liabilities and accounts for all assets. The leftover equity should accurately reflect the cost per share. A positive number signals stability, while a negative result may indicate looming financial trouble, possibly even bankruptcy. Limitations of financial statements. While financial statements are informative, they have limitations. Historical data. Financial statements report past performance and rely on interpretation to predict future success. Non-financial information. Important factors, such as brand reputation, employee morale, and market position, are not captured. Inflation. Financial statements do not account for inflation, and assets and liabilities are often recorded at historical costs. Reporting periods. Differences in reporting periods and estimates or assumptions used by management make cross-company comparisons challenging. How to prepare financial statements. Financial statements are critical for driving the insights needed to make intelligent, data-driven decisions that benefit the business. Following the steps below is a quick and easy way to start properly preparing effective financial statements. Balance sheet. 1. Choose your reporting period. 2. Determine your trial balance. 3. Add up assets. 4. Add up liabilities. 5. Determine shareholders' equity. Income statement. 1. Determine revenue. 2. Calculate the cost of goods sold. 3. Determine gross profit. 4. Determine expenses. 5. Calculate total income. 6. Determine taxes and interest. 7. Find net income. Cash flow statement. 1. Find your starting cash balance. 2. Calculate cash flow from operating activities. 3. Calculate cash flow from investing activities. 4. Calculate cash flow from investing activities. 4. Find your ending balance. Shareholders' equity. The formula for shareholders' equity is as follows. Shareholders' equity equals total assets, total liabilities. Analysis of financial statements. Common techniques for analysis and interpretation of financial statements are horizontal analysis. Trend analysis compares a company's financial data over multiple periods to identify trends and growth patterns. Vertical analysis. Common size analysis compares individual line items on a financial statement to a base figure within the same period. For an income statement, revenue is the base. For a balance sheet, total assets or liabilities and equity are used. Ratio analysis calculates and interprets financial ratios from different line items to measure a company's profitability, liquidity, solvency, and efficiency. Ratios can be compared against a company's own history, its competitors, or industry benchmark. Thank you.